Hey Trade Pros, this is Mark from Trade Pro Academy, and in this weekend's video, we're going to talk about how much risk you should be putting on per trade when trading futures. So grab a pen, a notepad, and a cup of coffee, and let's get at it. Now, before I get into how much risk you should be putting on for each one of your futures trades, I thought it'd be important to discuss quickly why position sizing is so important. All right, so first things first, position sizing correctly is going to help you remain objective to market opportunities, especially after you take a loss. You're going to take losses in this industry. It's an unrealistic expectation to expect to hit straight profits and never take a single loser. Right? In this industry, you're going to take losers, and position sizing is important to keep you around for the long run. All right? Position sizing is important because it will prevent you from blowing up your account in a single trade. A lot of traders that blow up, there's a 90-90-90 rule in this industry that 90% of traders will lose 90% of their capital in the first 90 days of trading. One of the major reasons for this is due to position sizing, throwing on too much risk for their account and getting wiped out when the trade goes against them. All right, there's a great adage in this industry: there are old traders, there are bull traders, but there are no old bull traders. And if you read between the lines, basically what this is saying is that position sizing is important. You will have traders that are bull traders. These are the traders putting on 10 to 20% of capital from their account into a single trade. And yes, this might pay off handsomely once or twice, but when that loser comes, and trust me, it will come, that can have a devastating effect. And most traders that are the bold ones tend to get wiped out after a single loss like that. So we want to prevent that. We want to keep you in this game for the long run, and position sizing correctly will do just that. So now, before we can get into how much you should be risking per trade in your futures trading, one thing that is important is that you need to have a strategy already. If you don't have a strategy, make sure to go out and back test one or forward test one in a simulated environment, and that will help you get to a strike rate. All right, so there's two main types of strategies that traders typically tend to employ. The first one is a strategy that has a low strike rate, meaning that you're going to be losing more often than you're going to be winning the trades. However, this is geared with a high risk to reward profile. So although you're going to be losing a majority of your trades, because you're risking $1 to make at least $2, you don't have to make more than 50% strike rate. All right, so that's one of the two strategies. The other strategy, which is the one that more day traders tend to employ, more short-term style traders tend to employ this. I have one of these strategies myself, is a strategy that has a high strike rate with a low risk to reward, right? So for a higher strike rate, we're greater than 50% here. What we are doing is we are reducing the size of our reward in exchange for a higher strike rate. All right, so whereas with this strategy here, you're going to be losing more often, but you're going to be making more on your winners than your losers. With this strategy, you're going to be winning more often, but your winners are not going to be as big as they would be with this strategy. All right, so that's kind of the trade-off. If you're using a strike rate that has a strategy that has a lower strike rate, you're likely going to have larger risk to reward profile. Whereas if you're using a strategy with a high strike rate, you're going to tend to have a lower risk to reward profile, usually under 2 to 1. Mine personally is around 1.5. All right, so what that means is for every dollar I'm risking, I'm looking to make $1.50 in return. And my strategy, the way that I've been trading it in the last couple of weeks or so, have been at around 60 to 63% the strike rate. All right, so because I'm winning a majority of my trades, I'm not necessarily risking as much, and at the same time, I'm not making as much, but because I have the higher strike rate, that just helps me from a psychological perspective. All right, so before you can get into how to properly position size for your account, you need to have your strike rate understood. All right, next thing, random distribution. So trading is a probabilities game. What I would recommend you to do is to take a read into the law of large numbers. However, in this video, I'm just going to cover it briefly. The distribution of winning and losing trades is completely random. It would be awesome if it was win, lose, win, lose, win, lose. That's not the case. It's a game of random distribution. And as such, what we need to determine in order to find out what our position size, our optimal position size would be, is the probabilities of a losing streak based on the strategies. So let me show you guys how to do this. All right. So probability of a losing streak, what I've done here is I've essentially taken 3 different strategies. So on your left-hand side, you've got a high strike rate strategy. This is a strategy that wins 60% of the time, loses 40. The middle strategy is a bit in between. It's a 50-50. So 50% of the time is winning, 50% of the time is losing. And this strategy to the right here is losing. It's a low strike rate strategy. So 40% of the time you got winning trades, 60% of the time you're going to be losing trades. All right. And so what this lot shows you here from 1 to 10, this is the number of consecutive losses. This middle column here is the percent chance of that happening. All right. So how we calculate this is you take the chance of a loss, which is 40%. You multiply by the number of trades here. So in this case, the probability of losing 2 consecutive trades with this strategy is 16%. How do we get that? We multiply 0.4 by 0.4 and we get 0.16. That's basically how this works across the board. And what this is showing you here for this strategy is that you've got a 1% chance of losing 5 consecutive trades with a strike rate of 60%. All right, if we move down, what this one will show you here is that you have a 1.56% chance of losing 6 consecutive trades in a row with a 50% strike rate. And down over here, what you'll see is that you've got a 1% chance to lose 9 consecutive trades utilizing a 40% strike rate. So what's important with this is that if you understand these numbers, it will help you optimize your position sizing. I'll show you how to do that just shortly. Before we do that, let me give you the rules of thumb. So these rules of thumb are really great, especially for newer traders. So newer traders, we generally recommend you risk no more than 2% of your capital per trade. At that, we actually recommend that you start with risking just 1% of your account for each trade and then scaling up as you get experience. All right. So why is risk management so important? Well, let's assume that you start with a $10,000 account. You have an absolutely terrible day where you blow $5,000 of it. All right. What is your actual loss in percent? Well, if you lose $5,000 of a $10,000 account, you've lost 50% of the account, right? So how much do you need to make that money back? Do you need 50%? Well, if you take a look at this grid, to make back a 50% gain, you're actually going to have to make 100% gain to make back that 50% gain. All right. So as you get further along down the scale here, really after 50%, it becomes very, very statistically improbable and very difficult to make that capital back. So what you'll see here is that a 10% drawdown will only require an 11% gain to get back to net neutral. 20% drawdown will require 25% gain. 30% drawdown will require 43% gain. 40% drawdown will require 67% gain. And 50 will require 100%, and so on and so forth. The thing that I want you to understand here is that after 30% drawdown, it becomes more and more statistically improbable and more difficult for you to make that money back. So in terms of drawdowns aren't ideal, but as far as actually planning for them, you'll kind of want to stay within the 20 to 30% because that still gives you the best fighting chance of sticking around for the long term. All right. So understanding why risk management is so important. Now let's show you how you can go ahead and optimize your risk per trade. So what we just mentioned, we like 20%, determine your maximum acceptable drawdown. We said 20%. Why? Because it's a realistic number and it's a number that we can still recover from if we do actually hit it. So strategy number one was our high strike rate strategy. This was the 60% strike rate strategy. With that strategy, you have a 1% chance of hitting 5 consecutive losers. All right. So if your maximum acceptable drawdown is 20% and you know your chances of hitting 5 consecutive losers is 1%, that means that you can go on and risk 4% per trade. What you're doing here is you're taking your maximum acceptable drawdown, 20%, and you're dividing that by the number of consecutive losers that you can take, and that's giving you 4%. So with this strategy, if you're risking 4% per trade, if you take 5 consecutive losers, which has a probability of 1%, your account is going to be drawn down by 20%. So what this should be doing is it should be giving you peace of mind to follow your strategy, to not get emotional. Understanding this with your risk helps you understand where you can focus, where you can control, and the profit will really take care of itself if you focus on strict and stringent risk management. So that's strategy number one. What if your strike rate isn't as good as 60%? What if your strike rate's at 50%? Well, for strategy number two, there was a 1% chance of 6 consecutive losers. So again, we follow the same process here, 3% risk per trade. How did we get to this? Well, 20% divided by 6 consecutive losers gives us 3.33. Because of the way futures contracts are sized, there's no fractions, you can only take singles. We've reduced that down to 3%. All right, so with 3% risk per trade with strategy 2, you can see that you can really optimize this once you've got your strategy in place, once you've got experience, once you're comfortable and you're at a psychological place with your mindset to be able to handle 3% risk per trade. That is when the opportunities and the profit potential really starts picking up, especially if you're a newer trader coming from trading 1% risk on your account, trading 2% risk on your account, etc. All right, so this is not an overnight game. This is a marathon, but if you start at 1% chance, if you start at 1% risk per trade, you're really giving yourself the best chance to get to a position where you can be trading that same strategy with an additional 2% risk. All right, that's strategy number 2. Strategy number 3 is the low strike rate strategy. This one was the strategy that was winning only 40% of the time. And with this strategy, what we've seen from our table is that there's going to be a 1% chance of hitting 9 consecutive losers in a row. All right, so even though those probabilities are low, what you can do from that, divide 20 by 9, that gives you 18, right? So 20 by 9, that gives you 2.22, round it down, that comes out to 2% per trade. All right, so even with a 40% strike rate, you can still do 2% risk per trade, understanding the fact that you have a 1% chance of losing 9 consecutive trades in a row. And even if that does happen, which is very unlikely, your account will only be drawn down by 20%, giving you a fighting chance to recover that, because all you'll need from 20% drawdown is a 25% gain. All right, so that is how to optimize your risk per trade, starting from 1% as a newbie trader, getting that experience, and then understanding what your win rate is. You're calculating the probabilities of a consecutive losing streak, and then defining your risk per trade based on that. Only after you've got the experience, after you're comfortable trading your own strategy with this kind of size. All right, so theory is great, but application is where the magic is made. So we're gonna combine those two together and show you guys an example of how to put this into practice, utilizing an example from the ES mini contracts. These are the S&P 500 futures, the most liquid and actively day traded asset, futures asset. So we'll start with this. So let's say your bracket here is a 5-tick stop loss, which means you'll be risking $62.50 per trade, with your reward being a 10-tick take profit, meaning $125 on that trade if it does end up a winner. So assuming you're starting with a $10,000 balance, as a newbie trader, only 1% risk per trade. This means you're only going to be trading one lot per trade. That is less than the 1% just because of the way futures contracts are priced. All right, so with one lot, $10,000 account balance, risking 1% risk per trade, one lot is your position size. Risking 2% per trade, you can put on two contracts. All right, two contracts. This is going to give you $125 worth of risk. Again, under your 200, which is 2% of 10,000. 3% risk per trade, you can put on up to 4 lots on that trade. This is going to give you a max risk of $250. And with 4% risk per trade, you can throw on as many as 6 lots, risking up to 375 risk per trade. So going back to our first example, assuming you've got a strike rate of say 60%, with a strike rate of 60%, you can go up to 4% risk per trade, understanding the fact that you'll hit 5 consecutive losers, or the probability of you hitting 5 consecutive losers being at 1%, right? So imagine this, as a newbie trader, you're starting with one lot and you're controlling your risk. And by the time you get that experience, you've put in enough practice, you've got enough data to show that you can make your strategy work. It's a high strike rate strategy. With 4%, going up from one lot to 6 lots, trading the same strategy, you can see the profit potential in there, in that shift between 1 and 2. The only caveat is many traders start right from here with a $10,000 balance. They start with 6 lots. The way that we're advising is for you to start with one lot and build your tolerance up. That way you'll still be trading the same strategy. You'll just have scaled and you'll be taking the same amount of points, except this time it's going to be on more lots. And that is the way to do it. That's the way to stay in this industry. And that's the way to make a career out of trading. So that being said, let me finish off with our final slide here, the reality of the trading industry. This is one of my favorites, and this is kind of how it looks. On these axes here, you have profit and you have time, all right? So the green line here is how it's sold to us by marketers, how trading is sold on YouTube, on the internet. I'm sure you've seen it. I'm sure that's what got you into this industry. I know that's what got me into the industry, was seeing traders in Lamborghinis, young traders in Lamborghinis on beaches, living that beach lifestyle, which is great. It's a great reason to get you into it, but that's not the actual reality of it. Those guys, those gurus will have you thinking you can set up a brokerage account, deposit your funds, and as soon as you start trading, here come the millions and you can retire and you can also live the beach life. Not how it works. The unfortunate reality of it is that many retail traders, they start off thinking they're going to make that money and they don't position size correctly. They overtrade, they put too much in a single trade, and they unfortunately blow out. As I mentioned earlier, the 90-90-90 rule, 90% of traders lose 90% of their money in the first 90 days of trading. That's the retail reality. That's what happens if you don't position size. In between the two, how it's sold by marketers and the actual retail reality is the TRADEPRO path. This is the path that we try to get our traders on, and it's a no nonsense, no fluff, no BS kind of a path. We set the expectations right from the start. You're not going to make money as soon as you start. Your goal when you're starting off is to survive. As you can see here, little bit of break even, you're learning how to survive. Once you can learn how to survive, then your wins are going to start compounding up. That's when you start getting back over to profitability. Now, once you get to that position where you're starting to scale up your positions, you're scaling up your trades with the amount of lots you're taking, this is when that growth tends to happen. All right, so our goal is to get you from start to here with as realistic expectations as possible. And in order to do that, position sizing is very, very important. So that's going to be a wrap for today's video. I hope you guys enjoyed this one. A little bit on the longer end, but I think that the value is there. If you do too, make sure to like the video, make sure to comment, make sure to subscribe to the channel, make sure to check off that notification bell to get notified anytime that we go live. so that you won't miss that content. Until next time, guys, good luck and good trading. Mark from TradePro Academy signing off. Have a great weekend. Take care, guys.